Hello
Hello,
everyone,
Shavez.
welcome Shin
Hello,
Chao, welcome
everyone.
to
Hello,
Vietnamese
Cynthia.
call. Shall we start? And before we start, very soon we are going to release one more feature on Rift. Very interesting feature, very not very different, but very interesting and really fun way to make money. Today we are going to start episode 20 of Rift Before You Quit, but we are going to cover almost half of this episode today because this is long, and then we will continue the rest on Friday. The AI Capital Manager. When machine begins managing capital better than humans. For nearly every generation throughout financial history, one assumption remained unchanged. Best investment decisions were made by humans. Successful investors were celebrated because of their intuition. Legendary traders become famous because they felt the market. Portfolio managers built careers around experience. And hedge fund managers were often described as possessing an almost supernatural ability to anticipate what would happen next. For decades, this belief shaped the entire financial history. Experience was considered the greatest competitive advantage. Instinct was considered irrepressible. Human judgment became the foundation of capital allocation. But history tells a different story. Every major financial revolution has removed another layer of human dependency. Trading floors replaced handwritten orders. Electronic exchanges replaced trading pits. Algorithms replaced manual execution. Quantitative models replaced discretionary decision making. Today, artificial intelligence is beginning to replace something far more valuable. Not traders, decision making itself. This does not mean humans disappear. It means machines increasingly assist humans in making better financial decisions. And perhaps one day they may make those many of those decisions entirely on their own. This is not science fiction. It's already happening. BlackRock manages more than 11 trillions in assets using sophisticated portfolio management technology. Sigma employs thousands of data scientists rather than traditional traders. Renaissance Technologies built one of the most profitable hedge funds in history using mathematical models instead of market opinions. JP Morgan invests billions of dollars annually into artificial intelligence research. Nasdaq itself relies heavily on algorithmic market structure. Modern finance is no longer driven solely by people. It is increasingly driven by the systems. But this shift introduces a profound question. If machines can process more information, react faster, remove emotion, analyze millions of market relationships simultaneously, could they eventually become better capital managers than humans? That question is becoming one of the most defining conversations in global finance. Because the future may no longer belong to those who predict markets. It may belong to those who build infrastructure that manages participation inside them. The evolution of capital management. Begin with human intuition by 1900s. Then in the 1980s, we began introducing computer assistants, and in 2000, we got into algorithmic execution. By 2010, we started employing quantitative investing. By 2020, machine learning came, and by 2030, it is predictive that we will have AI capital management. From instinct to intelligence. Imagine standing inside the New York Stock Exchange in 1985. Thousands of traders, hundreds of brokers shouting orders, paper tickets flying across trading desks, telephones ringing continuously. Every decision depended on a person. Someone watched a chart, someone interpreted the news, Someone placed the order.
Có người đặt lệnh.
Someone manually managed the position. Human speed defined market speed. Now, fast forward 40 years from then. Entire portfolio worth billions of dollars can now be rebalanced in milliseconds. No shouting, no paper, no phone calls, only infrastructure. Today's markets generate extraordinary amounts of information. A single trading day produces millions of transactions, billions of price updates, countless liquidity changes, continuous macroeconomic data, corporate announcements, social sentiment, blockchain activity, derivatives positioning, funding rates, open interest fluctuations, cross market correlations. No human being can process this amount of information in real time. Even the world's best traders face biological limitations. Our brains evolved to survive forests, not financial markets. This is precisely why institutions increasingly rely on machines. So machines do not become overwhelmed. Machines do not panic. Machines do not hesitate. Machines simply processes information faster, continuously without fatigue. The objective is not replacing intelligence. The objective is expanding it. Let's look at the market. During periods of heightened volatility, modern quantitative trading firms can analyze thousands of market variables simultaneously, including order book rebalance, liquidity depth, volatility clusters, correlation shifts, funding rates, market breadth, cross exchange pricing, historical probability models, portfolio exposure, execution latency. Most discretionary traders monitor only a small fraction of these variables at any given moment. This difference explains why institutional infrastructure increasingly outperforms manual analysis over long time horizons. Human decision loop and a decision AI decision loop. Let's understand the contrast. So, in the human decision loop, there is news that builds the emotion, which turns into interpretation. To carry on a decision, then there is decision, and on the basis of decision, there is execution, and post execution, there is hope for the price to go up or down. Whereas human decisions are episodic. So AI decision loop is fundamentally different. It consumes market data, it analyzes continuously, and then builds the probability model, which does risk assessment, and then it moves post risk assessment. Execution comes, and then post execution is continuous recalibration, not hope. AI decisions are continuous. Why humans are poor capital managers? One of the most important discoveries in modern economics did not come from Wall Street. It came from psychology. In 2002, psychologist Daniel Kahneman received Nobel Prize in Economic Sciences for demonstrating that human financial decisions are systematically irrational. His work fundamentally changed the understanding of markets. People do not make financial decisions objectively, they make them emotionally. Bless you, Ted. Behavioral finance identifies dozens of cognitive biases that affect investment performance. Among the most common are loss aversion. People experience the pain of losing approximately twice as intensely as the satisfaction of gaining. So better than pain of loss is bigger than joy of gaining or making profits. This often causes traders to hold losing positions for too long while closing profitable positions too early. Then there is confirmation bias. Investors naturally seek information that supports existing beliefs while ignoring contradictory evidence. This leads to poor decision making during rapidly changing market conditions. Overconfidence bias. Following a series of profitable trades, many investors begin to increasing position sizes excessively. Rather than attributing success to favorable market conditions, they assume superior skill. This frequently results in larger drawdowns. Recency bias. Humans tend to believe that recent market behavior will continue indefinitely. Bull markets encourage excessive optimism. Bear markets encourage excessive pessimism. History repeatedly demonstrates both.
Trong lịch sử thì đã nhiều lần chứng minh rằng cả hai cái giả định này đều là sai.
Perhaps the most recognizable bias in modern markets. When prices rise rapidly, investors abandon discipline and purchase assets solely because others are doing the same. Professional capital rarely behaves this way. Institutions typically increase discipline during periods of excitement. Retail participants often reduce it. If we look at the real market example of 2021 bull market, during 2021 bull market, millions of new investors entered the crypto market near cycle highs after months of rapid appreciation. Many purchased assets following extraordinary gains rather than before them. Institutional participants behaved differently. Numerous funds gradually reduced exposure as valuations expanded, rebalanced portfolios, and preserved liquidity. When markets corrected sharply in 2022, disciplined allocation often proved more valuable than aggressive speculation. The lesson was clear. Success was determined not by predicting the market, it was determined by managing capital. Human biases versus machine discipline. Human behavior revolves around fear, greed, panic selling, revenge trading, overconfidence, emotional decisions. AI behavior revolves around risk model allocation rules, probability analysis, portfolio optimization, statistical validation, continuous data processing. The greatest advantage of artificial intelligence is not speed, it is the absence of emotion. The financial industry has spent decades attempting to improve human decision making. Artificial intelligence takes a different approach. Instead of improving human judgment, it reduces the need for it. Machines never become tired, they never experience fear, they never chase headlines, they simply analyze, calculate, adapt, repeat. But the most important question still remains. If artificial intelligence can remove emotion, how does it actually manage billions of dollars? How do institutions trust machines with enormous pools of capital? That answer begins with modern AI portfolio manager. So from Friday we will start learning inside AI portfolio manager. Yeah, we will understand how AI portfolio managers they function and how they are going to replace a human AI human portfolio managers. So from Friday we continue rest part of episode 20. I think by Monday we will cover the whole episode 20. It's going to
Vâng.
take 3 sessions. And once we finish episode 20, we will move slowly towards 21 and 22. And post, I believe, 1 week from now, we will start understanding and learning about the new feature which is coming. Thank you. Thank you so much. I will see you all on Friday.